Hello, everybody. Welcome to the Alternative Investing Club Friday speaker series. We're going to get ready to go in about 5 minutes. Usually, while we were all on Zoom, I'd take this time to hear feedback from everybody. I see. Okay, good. We have people starting to come in. Let me make sure that the web page is still showing the registration link and not moving ahead to other weeks. Okay, we're looking good on that front. So while we're waiting for people to come in, hey Rebecca, can you see the number of people that are coming in so far? You don't have that info?
Mm-mm.
Okay. Well, it's starting with our regulars, I assume. Hey, since I can't actually take you guys off mute anymore due to this new software, could you just put in the chat where you're coming in from so that Rebecca can see the locations that you're arriving from? And Rebecca, where are you from?
I am located in Lynchburg, Virginia.
Excellent. That's right. I think I mentioned to you that I just took an accounting course at Liberty University.
Yeah, how was it?
It was good. It was a good course.
Yeah.
And of course, I did it all remotely. I live in the Portland, Oregon suburbs.
Oh, yes. Oh, it's beautiful out there.
It's rainy today.
Yeah, it's rainy today here too. I'm looking
All
forward to
right. Welcome here, Edward, JM, Peter. If you're arriving in here, just put in the chat where you're from. And we're going to give it about 5 minutes for people to join like we always have. Starting off a little slow. We've got 15 people currently. But usually at about 5 after, we've got 40 to 50 to 60. William, good to see you. Joseph, Robert, Nefertardi. I hope I got that name right. Good to see you.
We got a couple.
That's right, William. You're near my own old stopping grounds. I graduated from UC Davis. Folsom's representing. Folsom used to be our #1 location for people to come in from.
Yeah.
I think it's Portland now.
Okay.
And Chandler, Arizona definitely represents. All right. Well, if you have a topic that you want to hear about, please put it in the chat because I go out and find speakers based on what you guys want to hear. So if you're interested in a particular topic, if you want to hear more about oil and gas, purchasing businesses, if you want to bring back the people that ran their entire fund by buying barrels of whiskey and reselling them at higher prices, whatever the business model is. And we've got a couple of great business models that are coming up. First of all, I might wait a little longer just to get some more people in here. We've got a little over 30 currently. I'm going to announce that we have a new club fund speaker, and I'm actually going to announce this person a little bit in advance because their business model is very different than what we've done before in the past. A lot of what we've done before in the past was commercial real estate, where we bought a piece of property, we improved it, we shared the proceeds from that. We've had a couple of oil and gas deals. We've brought in some renewable energy groups as well, and then other interesting business models that like the buying and selling of whiskey barrels, which I don't know what I'd put that under, maybe miscellaneous. Innovative. Well, we've got some innovative strategies that are coming in here next week. And so I'm going to be sending out a series of emails to this group, just giving education on this particular business model because I love it. It's not only very profitable and has a good return on the fund, but it's also very charitable. And so the business, what this particular fund is, that'll be our next investment with our Alternative Investing Club fund. This group, they go and find first responders and veterans primarily, although not exclusively, who have crushing medical debt. They've been injured on the job, or maybe not on the job, but they just have medical debt that they're having trouble getting out of. And oftentimes they're paying it on their credit card, they're paying 30% rates, or they've stopped paying it altogether. They go and negotiate on their behalf with their creditors and will purchase the debt of that individual or that family. And usually they can purchase it for 30 to 40 cents on the dollar because it was non-performing. Plus, they can go and look at the fair credit laws and make sure if the creditor wasn't complying with them, which apparently a fairly significant number of them don't, they can actually go to court and invalidate almost half the debt. So they go and buy that debt. They then come back to the first responder or veteran. They restructure it. They drop their interest rate from whatever the credit card rate was down to 5% or in some cases even 0. And they give them a 2-year fixed plan to pay that off and get out of debt. And so they make their money by, of course, buying $1 worth of debt for 30 to 40 cents. That's how the investor return is made also. The first responder, they have a whole program that I won't go through here, but they'll go through. They're actually speaking next week. They have a whole program where they have that person begin making regular payments. And if they complete their 2 years worth of payments, their debt's paid off. If they don't, they're highly incentivized to do that, because if they don't, they actually revert back to whatever the previous, interest rate was with the previous creditor. So they're giving these people an off ramp, and for their investor returns, they give a 20% return annually, paid out quarterly. Or if we as a fund can come together and place more than $1 million with them, 25% annually paid out quarterly. So my goal is going to be to raise that $1 million or more and make that the next purchase in the Alternative Investing Club Fund. So I'm going to send out emails about that, and I, hope you receive them. If you don't want them, feel free to email me back. I'll take you off the list. That's fine. I'm going to start putting out, in addition to our regular Friday announcements that there's a Friday speaker, I'm going to start putting out more educational and what the fund is actually doing. The next thing I wanted to talk about is one of our speakers coming up, I believe in 3 weeks, is going to be with the airline industry. And so they actually are going to purchase airline assets such as airplanes and engines, and then lease them back to the airline industry. And they have a fund, and that's their business model. So we're bringing in not only real estate here, not only oil and gas, but different innovative private investment fund models. And the whole purpose here is to educate people and to up our ability to grow our portfolios and to find out people out there who are actually doing this in everyday life. So, and speaking of everyday life, Rebecca Taylor, welcome here. I saw you on LinkedIn. That's how I came across you. And I loved your post. You intermixed your business posts with family life, which is something I have kind of trouble doing, because I'm used to being, I was at Intel and large corporations for so long that I have a firewall kind of between the two. But I'm always attracted to people that want to share their personal lives too. And I think a lot of investors are. Yeah. So welcome to the group.
Yeah, thank you. It's good to be here. And I think we also connected, Daniel, maybe through a mastermind. Are you part of Jeff Greenberg's? I think we've.
Oh, that's right.
I think we connected initially.
I forgot about that.
Yeah,
that was
a bit, but
what, like 6 months, a year ago?
Yeah, probably a year ago. It's been a bit.
Yeah.
Yeah.
So, okay, great.
Thank you for the invitation. It's really good to be here.
Well, if you're new here and you have been listening to me ramble on, go ahead and put in the chat where you're from, because we're no longer able to take you off mute and just talk a little bit before it starts. So go ahead and say hi in the chat. And if you have any questions, put them in the chat. I'll be the moderator. Rebecca can talk, and during the middle of her talk, I'll judiciously interrupt her in order to put up your questions. So Rebecca, why don't you introduce yourself and take it away?
Absolutely.
Oh, also, if you want to share your slides, I see they're not shared yet.
Oh, let's.
With this software, you have to share your slides, and then they won't pop up on the screen immediately. I'll get a notification that you share them, and then I have to put them up.
Okay, perfect. I guess I could also do this right here. Let's see if that works.
And for everybody that's out there, okay, I see them. For everybody that's out there, if you have a topic that you want to hear about in the future, something that you're thinking about, put it in the chat. I want to know about it so I can go out and find speakers around it. All right. Take it away.
Perfect. Yeah. Well, thank you again, Daniel. It's really good to be here. You have created an incredible community. And we were just talking beforehand. He's been doing this since 2018. I mean, that is amazing that you've been doing this so long, such a service to so many investors. And It sounds like it's a labor of love that you're doing just to invest in other people. So thank you for doing this and for inviting me to be here. My name is Rebecca Taylor. I'm based in Lynchburg, Virginia, with my husband of 16 years and our 3 kids. And I'm going to share my story just briefly, if that's okay. I love hearing people's stories, and we all have important stories that often impact how we invest, for good or bad. So I'm excited to share a little bit about our story, how we ended up where we're at today. Early on, and I'll skip over, let's see, I'm hoping this works. Tell me, oh, maybe I have to, oh, we just want to see one page. Are you seeing 2 pages?
Yes, we are seeing 2 pages.
Oh, let's see if I can figure this out. Sorry, guys, I'm a little technically challenged. Let's try a different, let me do this on my page, if you don't mind.
Hey, Fang, on the topic of evaluating businesses and comparing that to multifamily, I actually did an interview this morning with Sun and Moon Capital, and they're a fund that buys businesses. So it's actually probably up on YouTube under the live area, and I'm going to invite them to speak in the club. They'll probably be in March.
All right.
Oh, Masterworks, Rodney. Oh, are the slides ready?
Working? Yeah. Perfect.
Okay, perfect.
All right. We're not going to dive into my whole biography, but just to give you some background, early on, my husband and I, we got married. We had some debt. We were really focused on making good financial decisions. Got out of college, had school loans, credit card debt, car loans, bought a house. We were just focused on, let's make as much money as we can and pay off everything that we can and just live frugally, like live our life wisely financially. I spent 10 years in the tech world doing sales and marketing. I was traveling a lot. I enjoyed my job, but it was difficult to balance as time went on with young kids, and I being all over the country. It made me kind of pause a little bit as time went on. I realized, I don't know if I want to keep doing this kind of schedule. But again, it's like you're making good money. So trying to balance that. So we're focused on paying off debt, making good decisions. We actually paid off our house before I turned 30, and we were in a good position. We were maxing out our Roths, maxing out our employee retirement funds, putting money into 529s, doing everything we could to make good choices. We bought our first rental back in 2012. And so we started to dip our feet into real estate and saw the benefits of it. And then eventually we wanted to have kids. We were big in serving and still are in our community, in our church. But then we got to this point of like, now what? What do we do? What's our next goal? And so we, hopefully this switches. Do you see that next screen, Daniel? Perfect. Okay. So 2016 rolls around and life was really put into perspective. We were pregnant with our first baby, and 12 days before her due date, I started to experience immense pain in my stomach and couldn't breathe. It got so bad I couldn't breathe. So my husband rushed me to the hospital, which was about an hour and a half away at the time, driving 90 down the road. I was literally in the back seat dying. It was a pretty rough situation. I had severe preeclampsia and severe HELP syndrome. So my liver was about to rupture and cutting off my oxygen supply. My blood pressure was 265 over 150. And it was just a really scary situation. They got me to the hospital. And the whole time I kept thinking, God, let me die. I don't want to live anymore because the pain is so, so bad, but please just let our baby live. I can't imagine my husband having to bury both of us. And so it was a really, a rough time. I had an emergency C-section, was put under, and then ended up having some more complications, had to have another surgery. I was in the ICU for a couple of days, and I ended up making it. It took a while to recover. I was in the hospital for a bit. But it was hard, I had to have help going to the bathroom, couldn't make it around the block for a while. It was a tough situation. And so that opened my eyes, I think, though, to see the value of life, and the fact that every day is a gift and I want to use it to the fullest. I don't want to just go about doing something and being in a place where I don't love being. I want to use my time to the best of my ability. And so that helped my mindset change a little bit. Plans change. I started valuing my time more. I negotiated a shorter work week and a new tech job that I took on. We started investing more. We actually did our first loan to a small bank or a small wealth company here locally. We did an $80,000 loan and made 12% annually. And it was just a great, very passive investment. And so we try to do more of those, just get outside of our normal box that I think a lot of times people get into with, the stock market and Roths and different things. We were able to expand our horizons. And so we really prioritize experiences and travel over more stuff. We kept investing in our community, our church. Then 2020 hit. We all know what happened in 2020. COVID was it changed a lot of things. And I think a lot of us were reevaluating what is life and what are we doing with our life? And so I was pretty tired of my job and just not passionate about it. And so I ended up quitting. I think people thought I was probably insane to quit a good job with good benefits, making good money in the midst of COVID. But we just decided it was time. My husband was given a 3-month sabbatical from his work. And so we bought a truck, we bought a camper, and we traveled the country with our 2 young kids in tow and had the time of our lives. It was amazing. We had some investments that were supporting that, some rentals. And so, but it was this really cool opportunity to dream and disconnect and just think about what we really wanted out of life. Here in our mid 30s, we're trying to figure things out. And so we decided during that time, real estate was really where I needed to focus my time. We had been doing it minimally, but my dad had been investing in real estate since 2004 out in Montana. So I'd been watching him and just grow his wealth exponentially. And it'd been really cool to learn from him. And so decided, hey, it's time to come back to Virginia and dive into real estate full time. So came back, got my license as a realtor, started doing transactions that way. We actually did a cash out refinance on our house. Pulled out hundreds of thousands of dollars of equity, which again, people probably thought were crazy. Here we are, we have a house that's paid off and now you're creating debt, but we got a 2.99% interest rate on our house. So that was some of the cheapest money we could get. And so we ended up putting that into more rental properties locally and then eventually into some passive deals. And that was honestly one of the best decisions that I think we made initially. And it's not for everybody. And I think you have to really think about your interest rates and what you're paying for that money. But it opened up new doors of really making our money work for us. And then we stumbled into passive investing. And so I had the chance to go work for a company called Wellings Capital. I think Paul Moore's been here before. I think he's spoken to the group. And so went and worked with Wellings Capital as their director of investor relations and invested in our first passive deal, a fund, put $100,000 into that we're still a part of today. And it was just a cool opportunity to see this other side. We're active investors, but now we get to be on the passive side as LPs. And I went to work for another group after that called Ascent Equity Group, doing just value add multifamily properties. So we invested in a couple more deals there, worked in that same capacity before leaving and starting our business, Tailored Investments. And that was in April of 2023. So it's been a journey. And during that time, our mission really is just to find, to analyze, and to acquire income generating real estate assets. We really want our investors' money to work harder than they do so that they can work less and live life more. Again, I think you can probably see we're passionate about time freedom and making our money work more so we don't have to. So these are just a couple of our acquisitions over the last couple of years. I don't have them all up here, but in different seats, LP, co-GP seats, we've done multifamily and assisted living. And we love this form of investing because I think it really is, it's incredible for our investors to just be able to be a part of it, but to not deal with toilets and tenants and trash. Like even locally, we have a property manager, and I still get texts and calls from her, and she's amazing. But on different things that we deal with, there is still some involvement as an active investor, even with a property manager. So on the passive side, I just love the fact that investors get to share in cash flow and appreciation and equity growth and tax benefits and diversification. And it's just really hands off. So you might be asking, why are you talking about syndications? I thought we were going to talk about hard money loans. Yes, good question. So let's get into that. So years ago, as we were having conversations with investors and as we were thinking about just timelines, I was at a conference, a real estate conference. And as people often do at real estate conferences, they ask, what do you do? What do you do in real estate? I mean, there are so many ways to make money in real estate. I love real estate for that reason. You will never run out of ways to make money in this space. And so I kept, I'm asking everybody, what do you do in real estate? What do you do in real estate? And the common theme I kept hearing, especially from seasoned investors, was I'm a lender. I'm a lender. I'm a private lender. I'm a hard money lender. I'm lending out my money. Do you need money? And so I was like, well, that's interesting. So many of these people here are lenders. Maybe we should think about being a lender. We have actually some capital sitting on the sideline. Like how many of you have capital that you're just sitting in an account that's maybe earning 2% for you, if that, maybe a little bit better, but it's just sitting on the sidelines and you're trying to figure out what do I do with this? Like, where am I going to get the best bang for my buck? And so we were in that place, what do we do with this money? We have some awesome syndications happening, but we may not be ready to have it tied up for 5, 7, 10 years. And so as we started to do some more research and, talk to other people, we're like, I think lending is something we should really think about. I was very involved in our real estate investor community here locally. And so I'm talking to rehabbers all the time. So I started telling them, hey, I have some capital available. Like, are you looking for a loan? And they're like, oh, that's interesting. Yes, I do. And so I want to share with you how you can become the bank. It's not that hard, but you do need to do your due diligence, and you need to have, and we'll dive into all of this, the appropriate paperwork. I mean, there's a lot that goes into it, but it's, I think, one of the best bangs for your buck when it comes to real estate and how to, make some good money on this front. So you may not be ready to flip houses. I mean, I am not a very handy person. If I was out on a job site doing things other than painting on a regular basis, I would probably hurt myself. So I think that lending is a really cool avenue to still be a part of seeing transformation in homes, in your communities. And again, consistent returns, but you're not having to do the work of being out on the job and flipping. It is a lot of work, and there's a lot that goes into it. So many pieces. And so I love the fact that, again, we can be the one lending the money, still be a part of it, but not be on that side of doing all the renovations ourselves. All right, let's skip to the next one. So what is hard money lending? I mean, a lot of you probably know this, but let me just recap for those that don't know. Hard money lending, it's a form of asset-based financing that's primarily used for real estate transactions. It's also called private money lending. I think I probably prefer the PML, like private money lending versus hard money lending, but people call it either term. It's an asset-based financing that's primarily used for real estate transactions. And unlike traditional bank loans, which are based on credit scores and financial history and you as the borrower, hard money loans are secured by the value of the property being purchased and rehabbed. So big difference there. These borrowers often need quick funding to purchase, renovate, and sell properties. The loans tend to have higher interest rates than traditional financing due to their short-term nature and higher risk. And so a little bit of a difference between the two. Take a note. Some of the key benefits, I think one of the big ones is the timing, the quick approval, and the funding. They can close in as little as 7 to 10 days. I mean, it's different for every lender and how quickly they can do the underwriting, make sure they have the funding in place, the closing, the time. I mean, there is a lot of pieces that have to fall into place, but it can be much quicker. I mean, how many of you have ever gone to the bank for a loan? I'm sure a lot of you, even for your home, for your own home loan. Like, did you go and work with a mortgage broker or the bank? And it was a process, right? Like, you probably had to fill out so much paperwork. I mean, it's unbelievable how much paperwork the bank wants. They want everything on you. They want to find out everything possible. And if you don't have a W-2 job, then it's a little harder to get loans. I mean, there's just so much complexity that goes into getting a loan. And so this is, I think, one of the gaps that a hard money lender is able to fill is you don't have to go by their box. You don't have all of these regulations, there's the FDIC, there's RESPA. I mean, there's like so much that's coming into play when going through a bank. They have their own box, whereas as a lender, private lender, we get to decide and we get to get creative. So timing is a big one. That's a key benefit. For us, we can earn attractive returns, often ranging from 10 to 15% annually. It's collaterally backed. The loan is secured by the property itself. And so your investment's really protected. I'm always asking myself, I heard this from another lender, will I smile if I have to take back this property? Will I be okay if they don't pay and I have to take it back and either flip it myself or hold on to it as a property, a rental property? Am I going to be okay with that? And so let me give you a quick analogy. I think this helps me understand because I get the question all the time, like, why don't people just go to the bank? It's cheaper. Well, think about a Coke. Like if you want a Coke and you can swing by Sheetz or convenience store on the way home. It's going to take you like 2 minutes to run inside, grab that Coke. It's going to cost maybe $3, but it's quick. I mean, it's like in and out and you have your Coke and you're able to enjoy it. Whereas you could go to Sam's Club on the other side of town. For us, it's like 20 minutes away. Go inside, you're going to have to show them your membership card, walk all the way to the back, and get your 24 pack for $20 or whatever it's costing. You're going to pay less than $1 per soda, but it's going to take you more time. It's not going to be as convenient. Like you're going to have a membership. Like there's just a lot more involved with getting the cheaper price. And that's the same with these guys. They don't want to deal with all of the paperwork, all the bureaucracy, all the time that it's going to take to get a loan through the bank. So coming this route, going through the hard lender, the hard money is just easier and more convenient. We kind of already hit on this, so I'm not going to dive into it, but you get to fill that gap. And that's what I love doing that. I love getting to be a part of helping provide a solution for these people locally that are transforming parts of our city that are really needing transformation, and providing housing, providing affordable, some of them affordable housing. It just depends. But it's really an opportunity to provide that solution for them. So the basics of becoming a hard money lender, you need to understand the risk and the reward. Hard money lending offers some really high returns, but it's also riskier than traditional investments. And you got to keep that in mind. You'll need to really assess the risk involved and learn how to protect your investment. In return, you can, again, earn high interest rates that often exceed other lending avenues. And so just understand that. Know the key players. I mean, these three go without saying: the borrower, obviously the rehabber that's doing the work, the property itself, the collateral, and the hard money lender, myself, you, if you want to do it. But there's also like an attorney. If you want to have an attorney do your documents, I have a good attorney that I trust that works on all of our documents. We've got title company that's doing the title work and the closing. We have, contractors involved that the borrower often isn't doing all the work by themselves. So do they have, subs lined up, contractors they're working with, maybe the city, if they've got to get permits, are they going to be okay to execute on their business plan? Is the city going to let them do that? They've got maybe a realtor that's looking at the property, giving them some numbers, maybe an appraiser. We've got on the back end when the property sells, you're going to have, that realtor that may be representing the buyer, that buyer themselves, mortgage company. I mean, there's a lot of other players involved. It's not quite as simple as these three that make the deal happen. So just keep that in mind too. We've run into some hiccups with a loan we did this last year that the guy was converting it from a single family to a triplex, and the city has just given him a lot of pushback with that conversion. And so he's had to change his business plan and move back to it being a single family home. And it's been a lot of work for him. It's taken longer, and it's been a little bit of a frustration. So you don't always know what's going to come up, but you need to know your key players in this game.
Hey, Rebecca, is this a good time for us to pause and ask some questions, or do you want to hold them a little longer? All right.
Let's get a drink.
All right.
I wasn't looking at the chat, so go ahead.
You don't need to worry about the chat. I'm storing all the questions up, and I'll keep track of them for you so you can concentrate on your talk.
Yeah.
Do you want me to ask them now or hold them for a little bit?
Yeah, we can ask a couple. Sure.
Okay, sure. Let's see here. Glenn is curious. After a few years after achieving FIRE, actually, I think I can put it up here. You seem to have returned to work. How much do you work now?
Oh, how much do I personally work now? Oh man, my schedule is flexible. That's one thing that's really helpful in this season. I work a lot because I'm running a business, and I think as a business owner, it's a whole nother world, and so. Oh God, I probably work at least a 40-hour work week, but sometimes my days, sometimes I'm working at night because I have kids. Like this week, for example, Daniel knows, everybody almost in my house got strep, and my daughter had an eardrum rupture. And so it's been a really tough week. My husband had a stomach bug last week. I mean, this is the world we live in. You just have to have some flexibility. And so my schedule's been a little bit all over the place because I've had kids home from school and I'm trying to juggle different things. So yeah, sometimes it means pushing meetings back a little bit, or working at night or on the weekends. So right now, I don't feel like I've probably navigated the time freedom as much as I want to, more so because I'm pouring so much into my business of myself. Like I'm just so excited and passionate about what I'm doing. It's hard to not work when you love what you do.
All right. Darshan is asking, is this lending money FDIC insured, or how are you securing it? Is the period to get the money back defined like 30 years?
Yeah.
Like a home, a home loan?
No, it is not FDIC insured. So yeah, I mean, absolutely. You need to know that it's secured by the collateral itself, by the property itself. So you're the one that, you hold the mortgage to that property. So Yeah, keep that in mind, and then it is, sorry, go ahead, Daniel.
Oh, I was just gonna say, it looks like from your slide, you're probably getting to some of the key terms here in order to define how you securitize the
Hmm.
loan to value ratio, the repayment schedule.
Absolutely. And the period of time we typically, and it's different for every lender. I mean, this is kind of the wild, wild west, I would say. With a bank, again, you have a lot of criteria, a lot of things that you have to stick to. Whereas with private lending, you as the lender, you get to kind of decide your terms. I mean, there certainly could be negotiation. It depends on who you're working with, but it is kind of the wild, wild west. I mean, there's truly like not a lot of rules around it. Every state's different. So I think you need to be aware of your state and the rules, talk to an attorney, do it the right way for sure. But there's some flexibility, creativity in how you can do it. So keep that in mind. With ours, we typically do a 6-month balloon. And then after that, they fall into some late fees and the interest rate goes up. And so we want them to be out of the loan within 12 months, ideally it'd be 6 months. But when I go into a new loan, I'm asking them that question. And if there is absolutely no way they can get it done in 6 months, we're going to figure out a creative solution that works for both of us.
So, for everybody that's out there, you should just know that if you're in Oregon or California, I'm not sure about Arizona, but in Oregon and California, you definitely have to register in order to make hard money loans. And there are definitely laws that you have to follow. So make sure you go and talk to an attorney or somebody who knows what they're doing in these areas in these states.
Yes, thank you
Um,
for bringing that up. I'm so glad you said that because I don't know all the states. We live in Virginia and it's different out here.
every state is different. Yeah.
Yeah,
And sometimes there are county laws too. so,
yeah,
so you have to be aware of them.
absolutely.
Um, And also, I love this business model. I actually, my wife and I, we actually did this back between 2006 and 2008. We were living overseas, actually in Europe, with a volunteer organization,
Mm.
and part of the way, and we had various churches that supported us to go over there. And one of the ways that we helped support ourselves was we actually did hard money loans back to the U.S. With a rehabber.
Oh,
And I did exactly the same thing that I
mhm.
think you're doing here, where we
Yep,
had a 6-month balloon.
yep.
We had a 15% annual interest rate, is what we were charging at the time.
Mhm.
So we get 7.5% back on after 6 months, and we charge a point or so, and
Yeah,
it worked out really well
yeah,
until
that's amazing.
2008. But that's a different story.
So you should be teaching this, Daniel. What am I doing here?
No, 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 no. They don't want to hear from me.
No, that's amazing. You've been doing it longer than I have. That's really cool. Do you want me to answer any of these other? Let's see. Do you want me
Yeah, let's go through. I can you see the ones that I starred? I think only I can see them. But one question is, where do you find your rehabbers?
Ooh, that's good. Um, One of the biggest areas is through our real estate investor community. It's our RIA group. We meet every Friday morning and then once a month and have a speaker. So I've spoken to the group before, but that's been a big avenue. And then I've gone to some conferences, met rehabbers there. One of the big thing is you have to think about how far out demographically you want to go. Because I was at a conference a couple weeks ago in Florida with it was all about hard money lending, and so there's a ton of rehabbers there, but some of them are working in like Louisiana and different states. So they weren't all a fit for me. But I do think conferences can be valuable. Another one is just referrals. Like I'll get one borrower that enjoys working with me and then they go tell their friends. And then I'll get more, borrowers that want to come that way. So that's been a really big one. It's just having good relationships where these guys are repeat borrowers and then tell their friends. That's my favorite.
Fang, I don't know if you're in Oregon or not, but here in Oregon, we've got the Northwest area. And every time that I've gone there, it's been packed full of rehabbers.
Mm, that's cool.
All right. How about we go on and
Yeah,
we'll hold the questions till a
sure.
little.
Yeah. So let's see. In terms of the loan terms, I mean, you need to have a really set clear terms for your loans, including that LTV, the loan to value ratio. How much money or how much are you willing to lend compared to the current value of the property? This is really, I mean, different for everybody and your risk tolerance. And I think you also need to really know what that property is valued at before the rehab and then after the rehab. If you're not familiar with your market, I would highly recommend hiring an appraiser or maybe getting a realtor out that can give you really solid numbers and comps to support that. So it's important that you know like how much you're not over leveraging yourself, giving them too much money, and then they don't end up executing, and you're in over your head, for this loan. So look at that. The interest rate. I've seen a pretty wide range, anywhere from 10 to 15%, depending on the deal. I've seen some people do like a 10% annualized rate at 2 or 3 points. I have a friend, a mentor that does 15% and 5 points, and they get that all day long. I mean, they're doing phenomenal. And so it really depends. One other thing I want to mention though, is look at your state usury laws, because every state is different. And that is basically telling you how much you're allowed to charge legally from a percentage standpoint. You don't want to get in trouble there. Please do things the right way. Again, this is sort of the wild, wild west, but you should do things the right way, the legal way, the fair way. Repayment schedule, hard money loans are typically short-term, like I said, 6 to 12 months. But it's different for everybody. Some people do longer term loans. I mean, it's really up to you and what you're looking for and what makes sense for you in your situation. And then in addition to interest, hard money lenders often charge upfront fees, like for the origination, for the underwriting, for the closing. This could range from 1 to 5 points, but it's, again, different for every lender. And you should really look at your market, I think is important too, to think about, where do you fall? I have some guys in our investor community, they're awesome, but they're always trying to get me down on my fees, and I'm like, sorry, that this is where it's at, like if you want to go talk to somebody else, that's great, but we kind of stick to where we're at, unless there's some major risk involved, then sometimes we'll charge more. Like if it's way out of our market, and we have to look at those situations. And again, we can get creative. Sometimes with like the LTV and the deals that we're doing, there's not enough equity in the property that we're loaning the borrower money on. And so we'll cross collateralize. We'll pull in another property that they own and add it to the loan, so that we have that security of having multiple assets tied to the loan. So how to evaluate a rehabber in a property. I think this is really, really important. You need to be skilled at evaluating both sides. I think the most important initially is that borrower, their character is vital. If you can't trust them in the beginning, when you're getting to know them, or they're lying to you, or anything comes up, I think that should be a red flag. You should run the other way. If they're not being honest, character is so important. And so I look at that. I mean, it's, you do as much as you can. You don't know everything about somebody, but another big one I look at is track record. We don't loan to people that are on their first flip. I want to see a track record. I want to know how long they've been doing it for. How many have they done? Can I see proof? Can I see pictures and the listings and their numbers? I want to know, what did they buy it for? What was the rehab? Did they end up getting where they thought they would be? Did their lender get paid back? How long did it take them? I really want to have a conversation and examples of their work. I want to know if they ever defaulted on a loan. Have they ever been foreclosed on? Can they provide references? That's a big one, is like, do they have a good reputation in your market? And where we live is fairly small, so reputation is important. So that's a big one, is just the track record. I'm looking at their financial stability. Do they have enough cash flow or resources to manage unexpected expenses? That happens, all the time. They might say and be overly optimistic that they're going to be able to get this job done and at this amount, and then they find some crazy thing in this house that they just didn't see initially. So you just need to be familiar with their situation. Where are they at? We had somebody come to us recently that wanted to borrow some money for a property. We went and looked at it. Really nice guy, hard worker. He'd done some other flips before. He was actually a referral from one of our other borrowers, so I appreciated that. But as we started to talk, he didn't have tax returns for his current business with flipping, but then he had another business that he'd done really well in over the years. He showed me his website and the reviews. He had phenomenal reviews, like happy customers, which I liked. But when I asked about his taxes, he hadn't been filing his taxes the last couple of years. And he's from another country. And so I'm sure there's some disconnect there a little bit, but that was enough of a red flag that I'm like, if you are not being honest with the government about where you're at financially, I don't know if you'll be honest with me. And I don't want to get in the middle of you and the government and what you owe them, especially if I'm putting my name on the line and buying this asset, I'm the one on the mortgage. So there's just that was something that I just couldn't move forward with. Some other people might be willing to. And again, you have the ability to choose, but those are some of the things that I look at. Is where are they at with the financial stability? Can I see, their last couple of months of their bank statements to see if they have some funds in their account? And then I really want to know the project plans. Do they have a clear strategy and timeline for the renovation? Like, how am I going to get paid back? At the end of the day, I need my money back and I need your interest and those fees. So, what's the plan and what happens if that plan doesn't work? What happens if, you can't sell it. I had another property the other day we were looking at, and it was in a little bit of a rougher area. I was a little bit concerned. I actually pulled up, it is a full gut rehab. And so I pulled up the area of town. It was concerning, but then I pulled up the sex registry, like the sex offender registry for that area. And there was like 11 sex offenders within a 1/4 mile radius of that property. And to me, that was like, I don't know. Like, I don't feel real comfortable, because if a family wants to buy the house and they see that, I think that's going to be a red flag for them too. So we did not fund that project. And it was with a good borrower that's phenomenal. He actually came back and said, well, if I can't sell it, I'd be fine with refinancing it and holding on to it as a rental. He's got a lot of other rentals. And so, there's different creative ways, but you as a lender have to figure out, like, what do I feel comfortable with? Like, what's my box, and stick to that box.
Hey, Rebecca, I wanted to let you know, I know you've got a lot of presentation here, but we also have enough questions right now that I don't think we could actually finish all of them.
Okay.
So you do the presentation as long as you want, and
Okay.
then just feel secure the fact that there are questions that will take you to the end.
Okay, perfect. I'll run through this really fast.
But do keep submitting the questions. I wanna find ones that are that apply to the most people. So if you've got good questions, keep submitting them.
Yeah, and I'll say too, at the end, you'll have my contact information. So if I don't get through all the questions, like, please reach out to me. I'm happy to hop on the phone and talk, or via email. So seeing the property, this is obviously very, very important. Well, this is your collateral. You don't, have any FDIC insurance. There's nothing there. This is the collateral that you have. So, what is the property worth in its current condition? And then, again, maybe getting a professional appraiser. If you don't know what the value is, get somebody out to tell you what that value is. Then look at the after repair value. What is it going to be worth after those renovations are completed? You need to have a good idea of the scope. And then I think the location is a big one. I just alluded to that, but you can update a house all day long, but you can't move it. I mean, unless it's a mobile home, but you're stuck with that location. So just keep that in mind too. That's not going anywhere. And just make sure that they're not putting too much into the house that they can't get that money back out for you. So here's just a quick example. This is one we finance. It's a townhouse. And honestly, it wasn't a huge renovation, mostly cosmetic. There's like a little sinking of the floor in the back in the kitchen. But it was a lighter job for this rehabber. So we were referred to them by another borrower that we've worked with. They passed along our name. And so we got together and started to get to know each other. And he shared this deal. It was off market. And I liked his track record. He'd been in business for a long time, already has a lot of flips under his belt, also his own rentals. And so he worked on it. It took him about a month and a half, 2 months to complete the job. But these were just the numbers at a high level glance. It was a $90,000 purchase price, $40,000 rehab budget that we did fund, and we did draws. So I didn't give it all to him at once. We use something that you should take note if you're going to do this, is there's some great software out there. We use a group called SiteWire. And so it's an app that our rehabbers can download. And when they're on the job site and they need a draw, $10,000, $15,000 draw, they are able to take pictures and videos of the property and show us where they're at in the update. And then they upload it. And there's an actual general contractor with SiteWire that will review those pictures and make sure that what they're doing has been done. They've actually followed through in or doing what they're saying. And then, they look at it and can decide, okay, yes, they're ready for their next draw. And so it's great because I don't have to be there every day or week or whatever, looking at the property, make sure that it's ready and they can handle another draw. I try to visit monthly, but that SiteWire has been super helpful for being, on the job for me in a sense. And so, we did draws. 200,000 was the ARV. We charge on this one a 13.5% annualized interest rate. We charged 3 origination points, and then it was a 6-month balloon. It's 4-month hold on this. The profit was around $97.50. There were some other fees like, I'm sorry, my voice is a little crackly, but there was like the draw fees we charged for that. He paid for his legal, like the attorney paperwork fees. He did all that. So every situation is a little bit different again, but that's just like a quick snapshot of, I probably spent 7 or 8 hours on this one. So when you think about the hourly amount that was made, it was over $1,000 an hour, which again is a pretty good return on our money, I think. So we'll run through this. We're going to wrap up here. If you're serious about setting up your own business, I think, having a good formal business structure is a smart idea. So make sure your lending criteria is outlined. You have your loan terms, interest rate, LTV ratios, loan amounts, all of that. Make sure that it's it's just standard, and that you have it to streamline your process. It makes it easier. We have our borrowers fill out an application. It is a little lengthy. I ask for a lot of information. Not every lender out there is doing that. We may do a background check. I want to see their taxes. There's a lot that we're looking for initially. Once they get past the first loan, typically it's a little bit easier. But initially, I just want to make sure that we have all of our I's dotted and T's crossed. And so the legal and regulatory compliance, I've already hit on this, but you just need to make sure that you're adhering to your state's laws, make sure you have capital. This is a big one. We started off with our own money initially. Then we started using retirement money, and then we started using some investor money as we grew, and we ran out of our own capital. And so everybody's different on this front. You may want to have a fund eventually, a little group that you're doing deals together with. Larger lenders they'll use like a credit line from a bank or some other institution, and they're paying them like 8 or 9 or 10% annually or whatever it may be to have access to a $10, $20 million credit line. So there's different ways of having capital. They make the spread on that, whatever they're charging, and then those points. And so, and then marketing a network, it's a balance of finding borrowers that need your money, but then also having the capital coming in to be able to fund those rehabs. So you have to have relationships with a lot of different people, from real estate agents to wholesalers, rehabbers, and attending investment clubs, whatever it may look like. Just making those connections, I think, is really important. And then just protecting your investment. I mean, this is so, so important. Make sure you have strong loan documents. I list a couple of them here. Deed of trust, your promissory note, your errors and omissions, assignment of rents, investor affidavit, your property insurance. There's a good number of documents to protect yourself. I don't let my borrowers bring documents to me. I'm not going to sign their documents. I provide the documents. They can review them and decide if they want to adhere to those terms and sign them. So keep that in mind. Like, if somebody's coming to you and saying, here's my documents, or here's how much I'll pay you, I don't think you should sit in that seat. It's your money. You can decide. Enforce a personal guarantee. Consider requiring those borrowers to sign a personal guarantee, which holds them personally responsible for the loan repayment. And I ask for driver's license and EIN, their LLC, and make sure it's in good standing, the operating agreement. And then again, working with professionals. I can't say this enough. Don't skimp on this. Use professionals. And then performing just regular inspections. I think that's also a huge one. Keep an eye on your money, on your asset. That's vital, I think. So we'll wrap up there. I'm sorry, I'm talking fast. I want to leave some time for questions.
That's great. I'm going to actually start with a question from Glenn, because it wraps right into keeping an eye on your money.
Yeah.
He's got a really good question here. Do you retain the dollars and give allocations to a rehabber based on their redevelopment plan, or do you lend the entire amount and let them work at their own pace?
No. So typically we just lend on, what the property purchase price is, and then we hold back if they are using us for some of the rehab. Like, I just talked to a guy yesterday, the day before. He has enough money to fund the rehab, so he doesn't need us to fund that. But a lot of times they need us to fund the rehab. So we hold on to that money and, allocate it for that specific job. And then when they're ready, we'll draw it. But I don't typically give them all at once, unless it's a really small rehab, which we've had those. But typically it's larger, like 50,000. So we're doing like a $10,000, $15,000 draw when they're ready for it.
All right. And then the most common question is, of course, tell us about a time when, and this is tying together a couple of different themes here. Tell us about a time when a deal didn't go well.
Yeah.
And kind of the related questions are, have you ever had to foreclose? And tell us about your worst deal.
Oh, I was hoping I wouldn't have this question, but it's good. Yeah, we have had a tough deal. Actually, the borrower got brain cancer, and he's not been doing very well. So he's not been able to execute at all on his plan. None of the work has been done. And so we are in the midst of foreclosure, and it's been a real pain in the butt, to be completely honest. And there's just lessons learned throughout those kind of situations. I think we haven't lost money yet. I hope that we don't, but we're going to take back the property and rehab it ourselves. I've been getting lots of quotes from contractors that are going to do the work. I've already got a lot of that honed in once we, foreclose and take the property back. But it's one of those situations, you just don't see it coming. It's just, things sometimes happen. People's health really deteriorates and takes a toll, and you have to figure out, what are we going to do? And that was with our own money. We weren't using any investor money in that, but it's just a situation that's been hard, and that's part of business. You run into situations and you figure out, okay, we got to figure out a solution and make it work. And, hopefully we don't lose our money in this. But it's part of it, just learning. So
All
good
right.
question.
William is asking, if I'm acting as an individual, how do I get my name out there?
Ooh. I mean, I think social media is a great avenue if you are active on social media, connecting with those investor communities. Like if the REIA has a meetup, going to that, but also posting on different pages about what you're doing and sharing, and then asking. I mean, I just texted a lender or a borrower right before this meeting that I had met with a couple days ago, and I was like, "Hey, Davina, love working with you. Do you have any friends that also need some capital, that are doing projects? We'd love to connect with them too." And she's like, "Yeah, absolutely. I'll send you some friends." So I think asking, it's kind of like a snowball effect as you start doing projects and people start hearing about what you're doing and, the way that you're working. If you're good to work with, they're going to tell their friends. So that's a big one. Social media, like I said, I think is great. The RIA. Yeah. Those are probably the biggest ways I would say.
Yeah, definitely. I mean, unless you're doing, 20 plus loans or so, you don't really need a marketing plan. Just going
Yeah.
to the RIA and getting a few people and getting
Mhm.
word of mouth started is pretty good.
Yeah, absolutely.
Excuse
Yeah.
me. Okay. Anita is asking,
Mhm.
what do you think is a good passive versus active real estate portfolio mix?
Ooh. I mean, that's tough. I think it's really personalized to the individual. I mean, you have to, yeah, think about like your time. I guess I'd probably go back and ask, like, do you have a W-2? How much extra time do you want to be spending in outside of your W-2? Yeah, I mean, active versus passive. I hope I'm understanding the question correctly. Um, I think, okay, so personally, I love the lending because we make really solid returns on that front, but we also love syndications because we see some really good like tax breaks with as we do bonus depreciation, we do cost segregation studies. So usually in the first few years, we're seeing a pretty large paper loss with some of those deals. So that helps offset the gains on the lending side. So I think it's a really nice it's nice to have them together. But for me, like all I do is real estate. So we also have some of our own active investments here. But for people that are doing, they got a W-2 job, you have to really think about, do I want to be working a whole lot extra over the hours that I'm spending in my W-2?
AB is asking, how do you split your time between sourcing, due diligence, funding, and transacting?
Ooh, that is a good question. That's a work in progress, AB. The the uh the funding comes pretty easy to me, like just because I'm always talking about what I'm doing and people get excited and like, oh, that's really interesting. I'd love to learn more. I mean, I feel like people are always knocking on my door, like, how do I get on a deal? I want to learn how to do this, or I'm just interested in something passive. So that it doesn't take, I feel like, quite as much. Sourcing is definitely something I have to focus my attention on more, getting borrowers in, like we talked about some of the different arenas that I'm doing that. So that's an area I'm focusing on more. Due diligence is definitely a time, like you need to do your due diligence. And so I try to spend a lot of time in that space and I have to allot the time for it. So I don't have a perfect breakdown of how I'm splitting my time. It's a work in progress because there's some times where, we've got a lot of loans happening at once. And so I'm out visiting job sites, checking on them, but I don't have as much time to be sourcing new stuff because I'm just so focused on what's happening in this moment. And so we're learning, like I said, using some softwares to help, like SiteWire is a big thing that's been helpful. And so realizing that you can't do it all and you have to figure out like where are your giftings, and initially you are going to do it all until you build something and bring on more people that can help you manage those different points of the job.
All right. Rodney's got a question. Do you avoid hard money lenders, lender business deals in high climate risk areas?
Ooh, I have not really encountered that. We've mostly stuck to our own market. Um, so I don't know how to answer to that, Rodney. I'm sorry. Yeah, we just haven't done anything really outside of, we have one other deal outside of our market, but it's not a high climate
Do,
risk area. So
do you tend to do all your deals kind of, within a radius that you can drive to and
yeah.
physically inspect?
Mhm.
Yeah.
Right now, yeah, that's been kind of our priority because I just feel more comfortable. Again, if I'm using my money or investor money, like I want to make sure that it is protected. And so
Yeah.
if I can drive to it and be a part of seeing it on a regular basis, that's really important for me.
Okay. Let's see. Oh, there was a question here about, I think it was this one. From Darshan. If we go through you to lend money, what are the fees? And is the lawyer aspect covered to ensure the security?
Mm.
Is the evaluation aspect covered?
Yeah. Yeah. So you're talking about like if you were to let me use your money, I think.
Yeah, I think that's what he's asking.
Yeah, yeah. So we have two different routes that we've have some lenders that want to come in and work alongside of us. They want to learn, and so we'll actually wrap their money. It is what we call it's a loan wrap. And so if they come in and they've got a certain amount of money and they want to do a deal with us, depending on how much they're able to put in, we can, if they're putting a majority of the capital into a deal, we can wrap it where they're in a first position lien on the property. And we work with them on the interest rate. Typically it's 10%, but that's dependent on how long the money is held for. So that's a lot more involvement. And so they're, again, they've got the collateral in their name, and some people love that. It is more work though, because you need to be reviewing documents, you need to be, signing on the loan. And so that's one route. And then we have some investors that totally want to be passive. And so we just offer them a 10% annualized return on their investment. And, you can definitely have your attorney review your docs on that. They're pretty simple docs that we provide. We don't have a fund. We have a friend that has a fund, a partner that we work with some. So that's an option. If you want to be in an official fund, that, you could go that route too. So there's a couple ways. I think I always ask people is what are you in it for? Do you want to be passive? You just want to earn some good returns on your money? Or do you want to learn how to do this and work alongside us and have us wrap a loan with you on it?
All right. Now that you've mentioned yourself here, I'll have you mention other people. Alex is asking, is there a database or site that you can recommend for finding reputable hard money lenders? Do they need to be local or be out of state?
That's a really good question. I don't know of a website. I will say SiteWire, who I've mentioned multiple times, they work with some really good hard money lenders. So checking with SiteWire might be a good place to ask them, for reputable lenders. And they could be local or out of state. I guess the question I would have back to Alex is, are you talking about for lending money to, or are you talking about borrowing money from? Because if it's borrowing money from, again, state by state, you have to think through those laws. And some of those lenders, they only work in their state or they only work in their proximity. So you have to think through, what side of the coin you're on. Does that make sense?
I think it does.
Yeah.
Let's see here.
I love LinkedIn too. I mean, LinkedIn and some of those other platforms, there's some good avenues to find people.
Let's see. Oh, here's a good one.
Mm-hmm.
What are some reasons to charge more or less origination points?
I think everybody's a little different in terms of like the time that they're putting into it on the front end and throughout the whole loan. I think some people, it's really to the discretion of the lender, and what you want to charge. One of our local competitors, they charge 13.5% and 4 points here. And they, I think they wrap their attorney fees into that. They may not push it back onto the borrower, but again, every lender's different in how they do that. So sometimes they'll include in their origination points some of the fees that they're incorporating into that. We do ask our borrower to pay for the attorney fees, and that's wrapped into the closing. But I think you have to just think through like what are my costs for doing business. If you're paying some software, if you are having to pay for the money, like you're not using your own money, there's things you just have to consider, like what am I paying for, and what am I going to charge back to the borrower? What do I need to make? And a lot of these guys that are big, again, they might be using a line of credit, and they're paying say 10% for that line of credit. So they're just making the split on the interest rate. So if they're charging 13.5% to their borrower, they're making that split of 3.5%, but they really make most of their money on the points. And especially if they can turn their money over twice and you're charging 3 or 4 points per loan, you're making then 6 to 8% on that money per year. I hope that makes sense. So a lot of the people I talked to in this space, most of their money is made on the point side because they're not using their own money. They're using other people's money or bank money.
Darshan is asking again, what is the risk and how to protect the investment? Is there a third party that helps in this? Did I already ask this question? I may have already asked this question.
I think we kind of already covered that.
I think, okay.
Yeah, I mean, it's the collateral, really the property itself. I mean, but yeah, it's risky. Like I want to be super clear. There is risk involved, and you should always take your time. Don't jump into something just because the returns look high. I cannot stress that enough. I've seen too many people lose money just because they're like, oh, those returns are amazing and I want that.
Muhammad is asking, do the rehabbers ever accept their own house as collateral?
So in this business, at least in Virginia, we cannot lend on primary homes. Like that gets into the mortgage broker. The mortgage, you have to have a license for that to lend on like a primary home that somebody's going to live in. So I can't touch any of that. It has to be an investment property, and they're using like an LLC. So I have never accepted somebody's primary home as collateral. I can't speak for everybody, but I would think that would be kind of in that gray line of like, you're not supposed to provide a loan to someone in a primary home without having your license.
Yeah, in the world of Fannie Mae and Freddie Mac too, if you're lending against multifamily properties, oftentimes the Fannie or Freddie will have clauses within their mortgages that explicitly forbid that type of activity or second loans.
Yeah.
So it can be tricky.
Yeah, absolutely. Absolutely.
All right.
Right. I should have pulled up. Yeah. Here's our contact info, by the way. So check out our
Okay.
website. We have some information there. Definitely join our email list too, because we'll keep you updated on what we're doing.
I'll not display the next couple of questions because I noticed that displaying it covers up your contact info.
Thank you.
But this is a good one to end on. It's 1:00. First of all, if we can't take you all off mute and have everybody say thank you to our speaker for being here, like we used to on Zoom, but if you would just put in the comments, thank you for being here, and let's thank our speaker for her taking time out of her busy day with a sick family to come talk to us.
Oh, of course. I'm glad to be here. Thank you guys. Thanks for listening.
And while people are doing that, Ruben is asking, is there a minimum investment amount for those who want to loan money through your company?
Yeah, we typically do 100,000, but I'd love to have a conversation and just hear about your goals and figure out what is it you're looking for. If we're not the right fit, we do have some connections in this industry, so we might be able to point you in the right direction with, if you have a lower amount that you're looking to place. And so I'm happy to make introductions and figure out, if there's a good solution out there.
All right. Thank you so much for being here, Rebecca, and hope you and the family start feeling better.
Oh, thank you. Appreciate it, Daniel. You guys have a great day. Thanks for being here.
Everybody have a wonderful day, and we'll see you again next week at this time. Bye.